Hello and welcome. My name's Brian Kaplan. I'm editor of The Banker magazine, and we're coming up to the World Economic Forum's annual meeting in Davos in Switzerland. Obviously that's a time when global leaders and very senior executives in both business and finance get together to try and plot out how they feel the world will shape up in 2011 and what the challenges facing both business and civil society will be. The Banker magazine always does a special issue for the World Economic Forum's annual meeting. This year in our January issue we've covered a range of topics, including we looked at the German banks, we looked at issues around trade finance, various aspects of regulation, and we've got a number of key players contributing to the magazine, including indeed the UK Chancellor of the Exchequer, George Osborne, and many other finance ministers and central bank governors from around the globe. So it's interesting for us on the editorial side to take stock of the issues that we think the World Economic Forum participants will be discussing. I'm here with Geraldine Lamb, who's the Investment Banking and Capital Markets Editor of The Banker. And Geraldine, you'll be attending the meeting this year. What have you got in your notebook as to the things that are likely to be the hot topics for the participants?
Well, aside from the key themes around which Davos will be built, I think some of the main topics of conversation are going to be the ongoing discussions about regulation. But we're expecting a raft of regulation. Well, we've already got some, but there's going to be a continuing onslaught of regulation sort of being imposed across the financial sector. I think the issue of currency wars will still be very topical, considering that Brazil is looking at it really carefully. Obviously, issues between China and the US and accusations of currency manipulation are still very, very high on the agenda. And also, of course, the Eurozone and the survival of the Eurozone. So I think that will be very topical. And of course, China won't go away. So the issue of what role China is going to be playing is going to be very important. I mean, I think one of the things that's becoming very clear is that China in its international relations is becoming increasingly sophisticated. So it's no longer just about sort of rampant growth and its sort of international aspirations, but it's beginning to balance those with a very strategic kind of approach to international relations. So we're increasingly seeing a much more sort of partnership approach and lots of cooperation with international companies and very much support of foreign governments. So for example, in the Eurozone, they have stated a very clear commitment to support of the Euro and a promise to buy the debt from those sovereigns that are at the heart of the Eurozone crisis. So I mean, how do you think that China's role is going to kind of play out over the next couple of years?
I think that's a fairly good assessment. I think that China's maturity and its participation in the G20 and its key role in the measures that were taken internationally coming out of the financial crisis have made China a much more responsible player on the world stage. And I think that all those things that you mention in terms of getting involved in buying debt issues from troubled countries and the strategic ventures that are doing, often connected with resources around the world, are all signs of China reaching out. But obviously one of the things they do have to do is they're trying to balance that international dimension with the pressures they face domestically. And the big challenge they face domestically, of course, is trying to rebalance their economy, because you've had an economy that's basically been an export machine, and it's basically been investing a huge quantity of surplus rather than consuming it. And it is really these global imbalances, this massive amount of China's exports on the one side and its huge savings rate, on the opposite side, the United States importing everything and consuming everything, which was the background to the crisis in the first place. And when you look at that aspect of international relations, not much has changed. So China's certainly acknowledging the difficulties, but I mean, saying that you understand the problem and actually doing something about it are quite difficult. Because if you think about it, what has to happen is you have to inject more consumer power into the Chinese economy. How do you do that? By raising wages And what happens if you raise wages? You make your exports uncompetitive.
And of course, it's foreign exchange reserves have now reached new record highs. I mean, I think they're approaching the $2.5 trillion mark. So
that's right.
It doesn't seem to be making that many changes.
So it's all going very slowly. And then on the other side of the thing, you have the kind of knock-on effects from what China actually did with this massive fiscal stimulus that they applied to the economy. A lot of that came out in form of bank lending, and that was bank lending to municipalities, often to go into property prices. And what they're calling it in China now, on the internet, because that's the main forum for discussion, is the surge. And they're talking about this surge in prices. And there's been some funny commentaries on it about, how long it would take you now to save up, if you're an ordinary worker, to save up to buy a one-bedroom flat in Beijing. And someone calculated that it would take you, an ordinary worker, since the fall of the Qinglong dynasty until now to be able to afford it. So there is that pressure from domestic China to, if you like, participate in this growth. And you've got a bit of an asset bubble as well. So you can start to see all these things that have to be balanced up if we're not going to see some sort of reversal in China. And of course that would be very catastrophic for the world economy when we're already experiencing problems in a lot of parts of Europe, and the United States doesn't seem to be any further along at all in solving its big problems.
And of course, China's, as we said, made this stated aim that it will support the euro. Moving on to the euro and the eurozone crisis, I mean, what are your thoughts around how that's going to play out? I mean, the markets are now almost writing in the prospect that Portugal is going to have to go cap in hand to the eurozone stability fund. And then potentially if Portugal goes, they're already thinking, well, maybe Spain's going to go. So, what's your feeling about that? I mean, can the euro survive? Can the eurozone survive?
Well, I think, and I'll stick my neck out here a bit, I think the logical outcome of all this crisis in the eurozone is a much more federal Europe. So you've only got two ways you can go, really. You can either say, well, okay, we're going to abandon the euro and go back to having national currencies, which for the countries in trouble would be an absolute disaster, and a huge loss of confidence and faith, really. Or you go the other way and say, look, in order for it to work better, we have to have a much more centralized system where we have much more common economic government, and we have a common tax policy, and we have a common fiscal policy, and these are the rules, and you have to keep to them. All right?
Yeah.
Now, whether that goes hand in hand with more democracy or more accountability in terms of the European Parliament, I would imagine that the national governments would start to ask for that. It remains to be seen. I don't think that everybody's quite taken that on board yet, but that seems to me the only way it can go. Because the whole fault line with the euro, right from the beginning, has always been that if you have a common currency, a common monetary policy, you must have a common fiscal policy. And what they've had is one without the other. That's what's led to the distortions. So that's where I see it going eventually. Now, how rough the ride is to get there, it may have to be quite rough, I think, because in order to acknowledge that, it may well be that we have to have a major economy getting itself into difficulties rather than just the more peripheral economies like Portugal, Greece and Ireland. And
of course the impact on the markets is really difficult to read, actually, because when Greece got into trouble, there was huge volatility in the markets, right the way through to derailing IPOs, etc. I mean, there was massive uncertainty, and yet when Ireland had problems, it was almost as if the markets had already factored that in. And in fact, the markets were relatively smooth. I mean, obviously, last year was a very volatile year, but the markets were relatively coherent. But everybody you speak to in the market say that they cannot sort of predict what will happen if Portugal goes down. I mean, have they already factored that in, and that means the markets will be smooth, or is it going to be just kind of one sovereign crisis too far, and will lead to a market meltdown?
Yeah, I think that, I was actually at a meeting this morning where we were talking about, it was like a pre-Davos meeting, we were talking about sort of risks facing the world economy. And one or two of the participants was saying, look, we live in very risky times and volatility now is the order of the day. We're entering an era of volatility, and part of the sort of function of globalization and global markets is that the shock spreads very fast and people react to everything in a bit of a herd instinct kind of way. And I think that the markets will kind of react day by day, hour by hour. So I think we are in for a lot of volatility until the whole thing is resolved. Now, the other thing, of course, that's going on as background to this is this sort of massive changes in regulation. The banks are really trying hard to kind of factor in what it means to them, what their returns are likely to be if they have to hold much more capital than in the past. And I know you've been looking at the challenges on the MiFID front, which again is basically a European-wide set of regulations. Again, it's one that had one intention, but seemed to produce 2 or 3 other intentions, unintended consequences. And now I think you've been looking at what they're trying to do to kind of set the course straight or set it on a different course. Is that correct?
Well, what happened is, MiFID, which is a directive, was introduced in November 2007, and as the financial crisis unfolded, regulators began to think that they needed to get a tighter sort of hold on opaque markets and commodity derivatives markets and this kind of thing. So they've put in place a MiFID review. And what began as a review has turned into a complete reassessment of traded markets in Europe. And it's going to be very far reaching and will have a very big impact on OTC derivatives markets. So, I mean, there's all kinds of provisions from greater data consolidation and collection and investor protection and the removal, quite importantly, of sort of national options and the national ability to sort of have discretions vis-a-vis your own industries or your own products. And they've introduced, or they're proposing to introduce new trading venues, mandatory trading requirements for those OTC derivatives that come under the European market infrastructure regulations. There's new requirements for commodity exchanges, as well as much tighter or fewer exemptions for commodities traders, which will have a really big impact, and also big supervisory powers, which are going to have the new supervisory body, the European Securities Market Authority, which will be based in Paris, is going to have some real teeth. So there's 2 or 3 things that are really making the markets worried, and one of those is the accelerated timeline. So the consultation document, which is only launched in mid-December, so just before the Christmas and New Year break, closes on the 2nd of February, and yet the Commission has already said it intends to have the proposed legislation or formal legislation in place by the spring.
So it's quite a tight timeline.
It's very tight.
So just what the financial world needed really was another stack of quite complicated regulations with all kinds of implications and done on a very quick timetable.
And more importantly, the industry fears that actually that tight timetable means that the Commission does not intend or doesn't even have the time to digest the comments that come out of the industry. So many people are seeing it that the proposals are actually virtually set in stone, and that the consultation process, I mean, that's just sort of lip service.
Right, okay.
And the other thing that they're really worried about is the ability, it's a newly introduced ability of this new authority, the European Securities Market Authority, to actually ban products, to put limits on them or to cap them. Now, of course, people in the city are seeing this as an opportunity for a France-based authority to squeeze London. But even the most sort of reasoned commentators are worried that whereas the regulatory process is supposed to help the markets work more efficiently, what will happen is in the post-crisis world, nervous regulators who are frightened about contagion will look at a product they don't quite understand, or one that doesn't sit very neatly within their mandated trading and clearing framework, and will just ban it.
Okay, well, we'll look forward to reading your report on the MiFID changes in Reg Rage in the February issue of The Banker. And you'll also have the opportunity to pick up on what the participants at the World Economic Forum meeting in Davos have to say about the other issues. So from Geraldine Lamb, Investment Banking Editor, Capital Markets Editor of The Banker, Brian Kaplan, have a good Davos.